Not everyone wants or needs to be a financial expert, but everyone, regardless of their knowledge level, should be familiar with the fundamentals of personal finance. Due to the fact that the finance category can be quite broad, it may be difficult to know where to begin. There are, however, a number of areas that you must become proficient in. If you are interested in a finance career and may want to consider pursuing a college degree in finance, but you are having difficulty understanding the concepts that will provide you with a solid foundation in the field, you have come to the right place. Here you will learn the fundamentals of finance, and you'll also be enlightened on how institutions use finance in their everyday operations. Hi, this is Finance Advisor. In today's episode, you will give you the best spotlight about finance, what it entails, and how it is applied in institutions. If you're new here, we welcome you, and at the same time officially invite you to join our adorable members. Kindly subscribe and click on the notification bell. And don't forget to smash the like and share button. Most importantly, your comment is highly welcome. Let's get started with the topic of today. What exactly is the basics of finance? In many ways, finance is an extension of economics and vice versa. Finance is the management, creation, and study of money, banking, credit, investments, assets, and liabilities that comprise financial systems, as well as the study of the financial instruments. Finance can be grouped into three main categories, and they are public, corporate, and personal finance. Corporate finance is the management of assets, liabilities, revenues, and debt for the benefit of a company's operations. Businesses can obtain financing in a variety of ways, ranging from equity investments to credit agreements. Here are a few examples. When a company takes out a loan from a bank or prepares for credit, it is acquiring and managing debt properly that will allow the company to grow and become more profitable in the end. Financial decisions and activities of an individual or household are defined as personal finance, which includes budgeting, insurance, mortgage planning, savings, and retirement planning. In most cases, the study of finance is limited to the analysis of prices, interest rates, money flows, and financial markets. When looking at finance in a broader sense, topics such as the time value of money, rates of return, cost of capital, optimal financial structures, and the quantification of risk are frequently discussed. One of the most important things about finance is the time value of money. Everything else is based on it. The idea is simple. Let me explain what I mean. It is because of the time value of money that the money we have now is worth more than the same amount of money we would have tomorrow or any day after today. How does this work as a building block for finance? When you look at some of the asset classes, like bonds or equities, you see that they all work in the same way that this one does. Let's think about a bond. 100 units is the price of the bond. As an investment, you buy a bond instead of giving the company money. This means you expect to get back more money than you gave them today. In other words, when the bond is over, you get back the original 100 units plus the periodic coupon payments or interest payments, which is called the yield of the bond or the return on your investment. However, even though the idea is simple in theory, it's a lot more complicated in real life. There is one thing though, if you can do this well, the next step will be a lot easier. Here are some basic financial terminologies. Net worth. People start with their net worth. A lot of people use the word net worth in their everyday lives, from financial experts talking about a company's value in dollars to magazines talking about a certain celebrity's worth in dollars. If you're talking about business, your net worth is the difference between how much money you have and how much money you owe to your creditors and other financial people, like investors. This word tells you how easy it is for people to get their hands on your assets, or how much money your assets would make if they were sold or bought today. The speed at which your business can make money can have a big impact on its financial health. Next is inflation. Inflation is when the prices of goods and services keep rising for a long time in comparison to the value of your country's money. People who work should keep an eye out for a way to tell if their income is rising in line with inflation in the country. As a result, if your business is global, inflation can have an effect on your prices when you sell outside of your country's borders. Compound interest is the addition of interest to the principal amount of a loan or deposit, or interest on interest. Truthfully, compound interest is a great deal. But don't buy into the idea that you can just deposit money into a savings account and not touch it for a certain number of years. Governments have plans in place to get the money out of dormant accounts after a certain number of years, so make sure you keep adding money to the account or make at least one small withdrawal each year. Capital gain is the difference between how much something is worth today and how much it cost when it was first purchased. Money as a time value. $1,000 today is far more valuable than $1,000 a year later. It is worth more today than it will be tomorrow because of its earning potential. Liquidity. An asset is said to be liquid if it can be easily sold or converted into cash with no loss in value. Examples include cash, stocks, and money in savings bank accounts. Risk tolerance is how much uncertainty someone is willing to accept when making a financial decision that could lead to a loss. Risk itself is the possibility of an unexpected or negative outcome. Risk can be defined as any action or activity that results in any type of loss. Every investment is fraught with danger. Some are less risky than others. To maximize the favorable side of personal finance, set up a way to make money that will keep coming in over time. Because when you spend money, you help other people live the lives they want. When your money goes, you need a way to keep replacing the money you spend with new money. So the cycle keeps going. Money moves around all the time. You pay your provider, and your provider pays their provider or staff, and so on. Such is the way money moves around. Avoid putting all of your eggs in one basket. It doesn't matter if you use one big investment vehicle or a lot of them. If we look at gold right now, it's going up, but a lot of company shares are going down. Why? This is because of a recent world event. Keep your money safe by not investing more than you can afford to lose. There are risks with any type of investment, no matter how small or big. One has to think about how much risk there is of losing money against how much money could be made. In terms of money, there are a few vital things to live by, but it doesn't mean you will win every time. But these financial basics will make you better off. You will have better organized plans than you would without them. But one thing you should be assured of is that if you apply these financial basics from now onwards, you will see a great improvement in your financial makeup. If you love the effort we put in here to create a great content like this, kindly join us by clicking the subscribe button and activate the notification bell to be the first that will view our next interesting videos. Until next time, please write us your thoughts about today's video in the comment section below.